All right. All right, good morning, everyone. Alex, a quick thank you. Everyone said it, but really appreciate you guys organizing this type of event. It's always nice to network with people and share Equiton's story. Just by way of introduction quickly, my name is Lawrence Raponi. I'm an Associate Vice President at Equiton Capital, okay? I've been, in real estate investing for pretty much all of my adult life. It started when I was 23 years old. I think me and three friends bought our first income producing property. It was a commercial property we repurposed to a lodging house and had no idea what we were doing at the time and spent way more money than we should have, took way longer than we should have, but learned a whole lot doing it. And I didn't know it back then, but that really pivoted my entire career trajectory into real estate. And that's pretty much how I got here. Beyond my real estate experience, I also have my MBA in investment management. So I'm pretty well versed on all things investment, whether it's derivatives, stocks, and real estate and otherwise. Today we're going to be speaking about Equiton. Okay, now Equiton is a private, there we go. Who is Equiton? So Equiton is a real estate investment firm, but specifically it is a private and passive real estate investment firm. And those two keywords are key to the value proposition that we provide investors and also contribute to the overall stability and the consistency of the investment. Now, we started our company back in 2015. There were three of us, an original investment amount of $1 million, and one apartment building that we bought out in Stratford. Tiny little thing, maybe 3 stories. You can see it right here. Fast forward to today, we have over 920 million in assets under management, over 8,000 investors, over 33 plus buildings, and a ton of developments that we do as well. We've literally doubled in value and sometimes tripled every single year we've been in existence, okay? That's a little bit of our growth trajectory. Now, at Equiton, we're rather unique because we're what I would call a fully integrated real estate investment firm. And that's just a fancy way of saying that we do everything at Equiton completely in-house. So we are real estate investors. We acquire real estate assets on behalf of our investors, but we're asset managers. And that's really the engine that drives our value proposition at Equiton. We preside over every one of our developments and buildings throughout that investment's life cycle. So we do all of our own property management in-house, but we also do all of our own development in-house as well, okay? Equiton Living would be our property management division. Equiton Developments would be our development division. And so we go about adding value sort of before we acquire an asset, and then after we acquire it, we're managing it the right way, and we're able to extract value in our investments in either of those phases. Now, I kind of said at the beginning those two key words, private and passive. So part of our value proposition at Equiton is the fact that we're a privately held company. We're not some stock that you can buy on the Toronto Stock Exchange or the NASDAQ or the New York Stock Exchange. And that has been crucial to the stability and the consistency of the investment. And I'm going to explain what the private markets are because a lot of people don't even know that these investments are an option for them, okay? So private investments are in some ways similar to public investments, except we're not publicly listed. And so if you think of this idea of a public investment like a stock, right? Let's take Tesla, everyone knows Tesla. The value of Tesla's share price is going to fluctuate pretty wildly with the stock market, right? The more buyers there are for Tesla, it's going to pump up in value, and then they're going to fall short of their quarterly deliveries on cars, and everyone's going to sell, and the thing drops. And then COVID comes out, and there's more volatility, and then Russia invades Ukraine, and there's more volatility, and then interest rates and inflation. I could go on forever. I won't. But my point is, these investments are risky, right? Volatility in my world is synonymous with risk. They're two sides of the exact same coin. When you're a private firm, we have eliminated much of this market risk because the value of our investments doesn't fluctuate wildly with the emotional whims of the stock market, right? These things aren't going up and down like a roller coaster because the value that's underpinning them is the physical value of the real estate that we hold. And that is how these things are priced. So what you're left with is an investment that has the form factor of a financial security like a stock. Right? You can invest with very, very low amounts. You can hold these investments in TFSA accounts, RSPs, but you have something with the pricing mechanics of physical buy and hold real estate. They rarely, if ever, drop in value if managed prudently, and of course we do, and there's minimum volatility. And more importantly, these investments are completely uncorrelated with the public markets, right? So when we saw Silicon Valley Bank fail last week and the entire market was thrown into a frenzy, Equiton's investments just even keel. Don't go up, but also don't go down, right? Now, in years past, these types of alternative investments, that's another word for private investments, they were only available to the super wealthy, the 1%ers, and institutional clients, right? People like hedge funds, university endowments, insurance companies. They would have access to these alternative investments. Now, legislation has since changed, and the eligibility requirements have come way, way down so that anyone can participate in these investments, right? Folks like you and I can all participate in privates. So I wanted to include this quick graph here to show you how stable this asset class can be. So this is a chart over the last approximately 35 years of just an index of privately held Canadian apartment buildings, right? So if you're driving down the street one day and you see a massive 20-story tower and you're looking and you're saying, I wonder who owns that? Well, first of all, it's probably us, and that's exactly the type of asset I'm talking about. And you can see here, they have literally never dropped in value in any of the last years from 1986 to 2022, and it survived 5 different financial crises. And it is a very, very stable asset, partly because it's a defensive asset, right? We are investing in shelter, and shelter is a necessity for many, many Canadians. Now, if you don't feel comfortable or you didn't understand that these types of investments were available to you, you can do what many Canadians have done, right? Invest in physical real estate. You go out, you buy a condo, pre-construction, you buy that duplex down the street from you, and you're gonna manage it yourself. And these are all great ways to invest in real estate. As I said, I own multiple properties, I still do. I know I build the space, and I like the space. But even when purchasing physical real estate, or what we call direct real estate ownership, there are serious hurdles to entry, right? Especially in the GTA. You need a massive down payment to buy one property. So you save up $200K and now you're fully concentrated onto one property. Number 2, you need financing, right? So in today's interest rate environment, you're now going to the bank, maybe BMO, and getting a, 6.5% interest rate on a 25-year mortgage that you're gonna have for a quarter century. Congratulations. And insofar as you can stomach those 2 things, now you have a part-time job, right? Because you need to maintain this property. You are providing a service to a client. Your client is your tenant, right? And you need to deliver on that service. So passive real estate investments like Equiton's are getting the exact same exposure to that physical real estate asset, the same type of stability, the same type of consistency, but without any of those 3 hurdles. It is a passive real estate investment for the investor. You don't need that massive down payment. You can invest with small amounts of money. You don't need financing. And you're leaving the ongoing management of these investments to the professionals at Equiton, or whichever company you may choose to work with. So there's lots of value added in a passive real estate investment just because we eliminate much of the hurdles that are associated with direct real estate ownership. Now, I wanted to give you guys a quick overview of the investments that we offer at Equiton, and I'm gonna go quickly through them because I didn't want this to be a sales pitch, okay? So in terms of how we structure our investments at Equiton, we have 2 different investment styles, okay? We have 3 investments in total, but you can break them down into 2 styles. We have funds and we have developments, okay? A fund is similar to a REIT, a real estate investment trust. By a quick show of hands, do you guys know what a REIT is? Yes, most people do. So a REIT, of course, is gonna give you that diversified exposure in multiple properties, right? Across multiple asset classes within real estate. And REITs also, in general, pay cash flow, right? So you're gonna have a monthly cash flow component to your investment in a REIT. And of course, you can buy and sell them with relative ease. Now, all of those qualities exist for our 2 funds as well. So very, very high cash flow producing. You're getting instant diversification across multiple properties. And yes, they're relatively liquid as well. You can move in and out of them subject to some limitations, but by and large, relatively easy to do. Now, forget about funds for 1 second, forget about REITs for a sec. Let's talk about the development. That's the big guy on the far right. Completely different investment. From a risk perspective and also a profitability perspective. Development investments are where investors are profiting from the physical construction of an asset, right? Could be a hotel, could be an office tower. In most cases, it's a condo or a subdivision. So 9 times out of 10, we're talking about either medium density or low density residential real estate. And these investments are, again, structurally completely different. Number 1, they're concentrated investments. So it's not a fund, you're not getting diversified exposure to multiple assets. You're investing directly into one build. And that build is going to be in a certain market, it's going to be a certain asset class, and it's going to be in a certain time period, right? For instance, a rising interest rate environment like today, even in the exact same market with the exact same building, is going to be a drastically different investment if you made the identical investment a decade ago. Very different projects. Number two, these development investments, as lucrative as they don't have a passive income component. So if you're the type of investor that wants that monthly cash flow coming in from that tenant month after month, you want it to fund a retirement lifestyle as an example, these are probably not for you, right? Because you're putting in a lump sum at day one, 5 or 6 or 7 years is going by, depending on the size and scope of the project, and on completion, when the asset is sold, you're given back all of your original capital plus a massive sum of profit, right? That's how these investments work. So it's naturally, I guess it lends itself well, I'll say, to an RSP account or a LIRA or something like that, which yes, you can invest with at Equiton. The last thing I'll say is that these are not liquid investments. Development investments cannot be sold. If you are in a 7-year project to build a 20-story condo, you can't decide 3 years into that 7-year project that, oh, you want your money back, because you cannot sell these investments. And think about that intuitively. When you give us $1 million to do a dev investment like this, we're spending your money, right? There's a cost of capital associated with constructing a 20-story tower, right? So you cannot pull out until completion. Now, for the reasons I just said, very, very restrictive investments. However, you're compensated for that restriction in the form of some very, very high profits. These are the type of investments where you can double your money every 5 years, right? And that kind of speaks for itself. So I wanted to take a deeper dive a little bit into our residential fund. I call it the apartment fund for short. So it is a classic long-term buy and hold strategy on residential real estate, right? We are going out, we are acquiring institutional grade real estate assets, most notably 15 to 20-story apartment buildings. We're managing them completely internally. We're collecting rental revenue. We're passing it through to our investors. So with this investment, there's a cash flow component and a capital appreciation component as well. So you're profiting as the buildings appreciate over time. And while that's occurring, you're of course getting a very, very healthy cash return month after month. We pay our distributions on the 15th. This gives you a sort of an overview of the geographic breakdown of our buildings. So we are a national investment firm. We have properties throughout the country, but you can see right here, the majority of our properties, and there are 32 of them, are located right here in southwestern Ontario, in around the Greater Golden Horseshoe, okay? We do have 2 properties out in Alberta, and we will be increasing our presence there later on this year, just because cap rates are very attractive out there. It's very easy to buy a cash flowing business out there, and maybe we'll talk about cap rate trends in our powwow afterwards, but it's by and large an Ontario-based fund currently. And again, just wanted to give some highlights of this investment. So earlier I told you that private investments like Equiton's, they're very stable, they're very consistent. This fund has been around for just shy of 8 years. It has literally never dropped in value. It has not happened, okay? So 82 consecutive months of positive returns since inception. And the results really speak for themselves. With this fund, it's not exactly going to double your money overnight. We're targeting overall returns annually between 8 and 12%, but what it lacks in nominal returns, it makes up for in stability and consistency, and that's the true value of the investment. We'll move on to our Sandstones condo development. So this would be that far one on the right with the annual returns of 20%. In this example, just as I said earlier, we're building a 12-story condo in Scarborough. It's actually a 4-minute drive from the Scarborough Bluffs. It's located at 2257 Kingston Road. And it is on the southern part of Kingston Road, and so we will have unobstructed lakefront views for the top, I would say 5 to 7 stories of the build, depending on what the final layout looks like. But again, it's a 5.5-year project approximately, but the total ROI, well over 100%. So to my earlier point, in a 5-year span, you're going to be doubling your money, and that's what we're projecting for this investment as well. Now the last investment, I'm going to skip that just in the interest of time, and I don't want to make this a sales pitch, but just to give you a quick overview of our last investment, it kind of sits in the middle of that very low risk, very conservative residential strategy and that higher risk, more concentrated development. And it's a mixture of both of those things. It's meant to be sort of a hybrid fund with part income producing assets and part real estate developments. Now, the targeted return in this fund is 12 to 16%. And again, you're going to be receiving that very consistent, stable cash flow. month after month from commercial properties and a little bit of private lending that we do within the fund. But while that's occurring, you are getting exposure to multiple developments. So not just one, we currently have 3 in the fund currently. So it's a great way to get diversified exposure to multiple developments without making that massive minimum investment amount up front, okay? I think I'm gonna skip some of this stuff because again, I don't want this to be too salesy. One thing I do want to cover quickly is eligibility. So earlier in my conversation, I mentioned that the eligibility requirements for these types of alternative investments have come way down, and this happened in 2016. So here you're getting a sense of what those eligibility requirements are. And essentially, as long as you make, as an individual, over 75K or as a household over 125K, which in the GTA is not a huge ask, or you have a net worth greater than 400K, which again, in the GTA, if you own a piece of property, not a massive ask, you qualify for these investments. And so you can see how approachable these investments really can be. All right, guys, thanks so much. I really appreciate you guys taking the time to listen.
It's very interesting. So next month, our presentation is actually going to be on pre-construction. And we have
nice.
The likes of Hunter Milbourne coming and speaking
really
about,
cool.
and one thought that comes to mind is, wow, so imagine that someone who's a realtor buys into a building that's about to be built just down the road from where they live, which is my case for that Kingston Road project. So they buy through Equiton into that, well, they invest through Equiton into that, and then they go and do pre-construction on that on the other side. So they're buying the food that they're selling to themselves. That's really interesting.
In that sense, they are their own exit strategy.
Yeah.
Right? So it's really weird. So yes, with the development, for instance, if we're building a condo, we're the first ones in, we're constructing the asset. And so our exit strategy as an investor is when we sell those units pre-construction, then we build the asset until occupancy is achieved. That's the point at which we hand over the keys to the end user or investor, and that is when your full purchase amount is due. That's the profit that goes back to investors at day one. So you're effectively purchasing it from yourself in that instance. And it's very, very common for clients to say, look, I want to put 25, 50K, whatever on the sandstones, which is our development. And then their next question is, what opportunity do I have to buy a pre-construction unit?
100%.
Do I get first right of refusal? And the answer in most cases is yes. Now, we don't offer super steep discounts because we're investors first.
Yeah.
So the more discounts we give people, the less lucrative the investment becomes. You need to understand that. So we don't really give discounts, but first right of refusal is super common. So you get your pick of whatever unit you want, which is kind of nice.
That's awesome. Thank you. Any other question?
Any other questions?
I have one.
Yeah, sure.
What sort of risks would investors need to take into consideration in these 20% programs?
Yeah, I think I could speak an hour on that. So I'll speak about the risks for Equiton in general. So you need to understand that because when you make an investment, let's say you put in $100,000, I'm going to go out and buy physical real estate with that. I'm going to put that towards the down payment of a commercial plaza, an apartment building, whatever the case may be. So the risks inherent in direct real estate investing is the very same risks that we're exposed to, right? Net migration dynamics, supply and demand for certain real estate asset classes, interest rates, right? All of these things are the same risks for us. On a development, it's much more complicated because when you're navigating through the development process, there's various steps, but it's particularly surrounding the approval process. There's a lot of unknowns, there's a lot of uncertainty. Exactly. You don't know really what you're going to find.
The price of toilets could change
Yeah,
drastically.
exactly.
Yeah.
Well,
The
example I give is if you started a condo dev in 2019, and some analyst ran into your boardroom, all the developers sitting there. They said, guys, there's going to be an international pandemic next year that's going to quadruple the price of concrete and steel and shut down job sites everywhere, right? They put a straitjacket on you. But that is what happened, right? And all developments were impacted, right? Hard costs went up, job sites were shut down, so there was a time delay aspect with it. And then, of course, the municipality goes on pretty much vacation, and so we have all of these approvals backed up in the system. Now it's really hard to get a project started. So there's all of these, it's like a butterfly effect. Something happens on one end of the project's timeline and it ripples throughout the project. So developments are kind of unique in that regard because the risks are many. Now, I've also been on projects where something seemingly negative has happened and it's ended up being a positive. So I was on a development, it was a low-rise project where we got delayed in the approval process. It was in Kleinberg. So we got delayed in the approval process. It took a year and a half longer than normal, which is terrible. But in that year and a half, the property asset values in Kleinberg went up like 24%. And that made the project overall so that we all made more money with the delay than if it had just gone according to plan. Now, it doesn't always work out that way, but my point is that something that happens over here will ripple through and have unforeseen consequences over there, right? And every development is different.
Final question.
Yes.
There was one at the back, and then we'll do a Q&A at the end as well.
Yeah. You guys highlighted the apartment. You highlighted the apartment fund. You guys have other funds and other asset classes.
Yes, so we have two different funds. We have the residential fund, the apartment fund, and then we have an income and development fund, which sort of is a hybrid between developments and income producing assets. The residential fund is an apartment fund, residential. The income and development actually focuses on commercial properties and private lending as the source of cash flow, and it also has exposure to those developments. So it's a more diversified fund. It's kind of like a jack of all trades investment vehicle.
Awesome. Thank you so much, Lawrence.
Thank
That was
you guys,
great.
appreciate it.